An inside bar can be a valuable predictor of trend continuation. Here's how you can program an inside bar and use it to improve your trend following strategy.
An inside bar is one whose high-low price range is completely within the price range of the preceding bar. Algorithmically speaking, the inside bar's high must be lower than the previous high, and the inside bar's low must be higher than the previous low. Markets usually alternate between periods of volatility and consolidation. Inside bars often appear during consolidations and indicate a brief period of calmness. Market participants could be taking profits after riding the initial wave of a trend, or they could be awaiting a major news release. During these consolidations, any fundamental impetus, such as a positive economic report, can create a strong breakout. Traders who were previously waiting on the sidelines quickly jump into the market, amplifying and sustaining the emerging trend. The longer the prior consolidation, the stronger the breakout tends to be. Depending on the context in which they appear, inside bars can be used to predict trend reversals and continuations. I'll focus on trend continuations in this case. Before I program any strategy, I think of what market phenomenon I'm trying to capture. Here's the sequence of events I'm looking for. A brief trend followed by consolidation. An inside bar, which indicates volatility contraction. A breakout of the consolidation range, and the trend continues. Pattern recognition is a challenging aspect of automated trading. Patterns that are obvious to the human eye can be difficult to convert into black and white programming rules. Let's start with something simple. Here are the rules to detect an uptrend continuation. An upwards bar occurs, meaning prices close higher. This is followed by an inside bar. Another upwards bar occurs. The rules were converted to pseudocode in AlgoWizard. The number in square brackets indicates the bar shift. 1 means the most recently completed bar, while 2 refers to the bar before that, and so on. The rules for detecting downtrends are the opposite. A downwards bar occurs, meaning prices close lower. This is followed by an inside bar. Another downwards bar occurs. Before backtesting, I need to minimize the risk of catching false breakouts. To improve win rate, I'll add 2 entry filters. The first is a long-term trend filter. To trade in the direction of the long-term trend, I will only go long when prices close above the 100-period EMA. Conversely, shorts will require the close to be below the 100-period EMA. The second is a stop order filter. When the entry conditions are met, a buy stop will be placed at the previous bar's high. This means I'll only enter the market after seeing some evidence of trend continuation. For shorts, the sell stop will be placed at the previous low. With both filters in place, a long entry now looks like this. And here's a short entry. Finally, I'll keep risk management simple by throwing in a 120 pip trailing stop and exit all trades on Friday. As usual, I run a 10-year backtest to verify that the strategy has some long-term edge. That's not bad for a simple strategy. The pound yen is known to trend pretty well though. Are the results purely due to the market's trendiness? To find out, I remove the inside bar conditions. The strategy now places buy or sell stops when prices close above or below the 100-period EMA, respectively. I wouldn't touch that with a 10-foot pole. I've found that adding some sort of pullback or consolidation filter, like the inside bar conditions in this case, usually improve your trend following strategy. So inside bars represent volatility contraction and often precede explosive breakouts. The entry conditions above should be used as a starting point. You can improve your win rate by being more stringent with your inside bar conditions. For example, you could target a series of inside bars, or target the strongest volatility contractions. An example is the classic Harami cross pattern, where you have a very small range relative to the previous bar, and a thin real body, indicating indecision in the market. Add in at least 1 entry filter to avoid false breakouts, and you should be good to go. Do support the channel by liking and subscribing, and stay tuned for more strategies.